Securing funding for a new business venture can be a really difficult undertaking. And if the startup management isn't well prepared, it's not only a detriment to you in the short term, it has long-term implications because the lender community is small and people talk to each other. And you may not get a second chance. So when seeking funding for your new company, make sure you are prepared. To help you in this preparation, we've assembled this august panel of individuals who are deeply involved in assessing startup companies and helping them grow. Their advice today will be very useful in ensuring that you have the right information, the best documentation, and the right team put together to impress potential investors. Please join me in welcoming our panel. Here we have Joan Zeef, who is the Managing Director at Golden Seeds Fund and Angel Network. Ray Theck, who's Vice Chair of the Tech Group at the law firm of Lowenstein and Sandler, and SVC Entrepreneur in Residence. Jonathan Hakakian, Managing Director at Soundboard Angel Fund, and also an SVC Entrepreneur in Residence. Arkel Desir, Founder and President of Hyperion Advisory, and last but not least, Dick Kundari, Founder and President of US Ventures and a member of the SVC Advisory Board. So let's start by saying, and these are all from the perspective of the young entrepreneurs. So how do I know when I'm ready for funding?
All right, how do you know when you're ready to seek funding? Well, the most important thing is that you need visibility in the trajectory of your business. You need to know that you have the product, that you have your customers, that you have a go-to-market strategy, pricing, and understanding of the costs, what it means to be successful, sort of how you scale a business. And so I think when you have that visibility, then you can come to investors and present your case.
So when are you ready for funding? Well, you can check your bank account. That will tell you when you're when you're ready for funding. When you're capable of actually obtaining funding, that may be a different answer. I think it depends quite a lot on funding at what stage and who you're going to be talking to. I think fundraising ultimately is just a specific category of networking. So the thing that you need to do if you're going to be in the startup space right off the bat, whether you've already started your business, whether you're thinking of it, whether you don't have an idea yet, but you know you want to live in that life, is start networking. Start getting out there, meeting people who are in the venture and innovation space, making sure they know who you are, talk to them, know who they are, know how they think, know what checks they like to write at what stage, so that you learn from them. If you're trying to raise $100,000 in friends and family money, there's a different requirement for that in terms of your own readiness capability than there is if you're trying to raise $750,000 of seed capital, than there is if you're trying to raise $2 million of Series A capital than there is if you're trying to raise $5 million of growth stage capital. So first and foremost, I would say is get out there, network, talk to people, understand what they think as check writers the requirements are for the vertical space that you're in. Differs, if you're a life science company, is very different than if you're building a software-based business than if you're building a material science-based business. The requirements that people, and the sources that you would seek. So go network and talk to the people who write those kind of checks and ask them.
So for me, I would actually flip the question. It's not so much when are you ready, it's why do you want to raise funding? And most companies probably shouldn't raise any money because they can subsist and be very profitable on their own without investor capital. And so it's really debating that in your own heads that I would push each entrepreneur, each of you to do is, should I raise? Why should I raise? Do I want to have investors that want me to report to them, that are going to have incentives that aren't necessarily aligned with my own? And that's really where, a power struggle internally that you have to deal with.
For me, I'd like to piggyback off of what John was saying, and it's really about fulfillment. If your demand is such that you don't have enough to fulfill the orders that someone is requesting from you, that's typically the right time to go and seek outside funding because you yourself or your team that exists isn't capable of fulfilling certain orders without an influx of cash to help you execute and deliver on those either promises or requests. So I think if you look at your business and see a spike in demand for a supply that you don't necessarily have, that's typically when you should probably consider maybe I should raise some funds to boost the supply to meet the demand.
You won't have a problem if that's the case. If you have more demand than supply, you have a good problem.
Let me answer it from the perspective of it being asked by a very small startup seed kind of company as are in the incubator. You're small, you're looking for very early money, and they're the normal things you can obviously know that you need. You need a product plan, and a pro forma P&L, and so forth and so on. But probably the single most important thing you need is proof that your product or service or offer that you're developing is a viable product. In other words, you can wave your arms about your product plan and what you've got, but you have to be able to say, and here's how I prove it. I have orders for it, or it's been attested to by some testing agency, or whatever it might be. So the question that investors will ask will say, I understand what you've got as a product and you think it's the greatest thing since chocolate ice cream, but how do I know it's really good as a product and that somebody's going to buy it? So if you have to come from that point of view and make sure that that base is covered in terms of readiness to raise money.
Okay, what would I first approach potential investors with? A one-page executive summary, a pitch deck, or do I need a full business plan prepared before I start?
The 90th percentile of folks I work with, whether as clients or portfolio companies of my own angel investments, had the luxury of making a decision not to raise money. That would be a miracle. Most of them are in a position where they can only continue from the stage that they're at to the stage that they're going to, because they don't yet have even a beta product. So what are you trying to approach people with? Well, the first step I would say is let's think about what you're not trying to approach them with. You're not trying to approach them with, I need money because if I had the money then I could leave my full-time job. And for you guys who I know who are in it, how many times have you seen that in a fundraising pitch, and have you ever invested in a company that had that in their fundraising pitch? So the first thing to understand is it is not the job of the investor to de-risk your life. It is your job to de-risk the investor's investment. So if you're not willing to commit full-time and eat hot dogs and ramen noodles, don't expect the investor to come and write you a check. The second thing I would warn against is don't calculate the amount of money you need as a function of time. Right? Nobody will be interested in investing in your business/project if what you say is, well, I'd like to have 18 months, and since it costs me X dollars per month and I multiply 18 times X, here's the amount of money that I need. Right? People don't invest to keep you alive. They invest because they believe over that period of time you're adding value. So explain why there will be an increase in value from the time that check is written to you to the next time when you're going to need money, because there's probably going to be a next time or two that you will need money. For the most part, what you need then is the ability to have that conversation. A one-pager is helpful if you're doing, and I would focus on that first, if you're doing the right kind of networking, because most very early stage investment, let's talk about the first $1 million that a company might raise, and that $1 million might come in 2 or 3 chunks over a period of time, is going to be raised by people who are being introduced to you in a warm fashion by others who believe in you. It is incredibly rare that you send a cold piece of paper or email or something out into the marketplace and people suddenly call you. Right? You need to find people in your network who you can get to know. Adrian is one of them, all the other folks on this panel, the EIRs at Stevens, who understand your idea, believe in your idea, and are willing to expose people in their network to what you're doing. And the way you enable them to do that is by handing them a very short, simple thing Remember, people who do this see hundreds and hundreds of opportunities. They only want to read a couple of paragraphs to understand what your idea is and how much money you need, and then they'll make a decision. Do I go further and ask more questions?
That's a great point. The first few meetings or contacts with an investor is all about getting the next one. It's not to get them to sign a check today, because that doesn't happen. That's only in TV shows and yeah. The things that I would work on, one is the elevator pitch, which is in tandem with the executive summary or pitch deck. Make sure you can explain what you do easily and simply and succinctly. If I have to spend 3 hours trying to figure it out, you lost me. The other thing that was in the question is about a business plan. A business plan is great, but as an internal document for you and your team. I don't think I've read a business plan in 10 years. And we won't, because it's too detailed. I get all that information from research and from conversations with the entrepreneur. That's got to come out. So it's a tool that you can use internally to be able to clarify your vision, your mission, and all your objectives.
So, how do you feel about a marketing plan, not a business plan? In the sense that it's a short, quick instruction manual on where the company is going to build its product. Is that something you would recommend, or is it the same thing like a business plan, too detailed, not the right time, maybe if it's asked for?
Don't send it up front. Wait until the diligence gets to that point. But it's definitely worthwhile to have.
I think it was mentioned before, but a conversation is the first thing you should approach a potential investor with. Talking about what you've done to this point that's along the lines of your business plan that you've developed. Like John said, no one cares to read it. They want to hear what you're doing that you put down on paper in terms of action, right? So if you can converse eloquently about what actions you're taking each day, each week, each month to execute along those lines, that's really what you would approach a potential investor with.
Yeah, I would say probably two things. The question is, what exactly would I approach an investor with? You should be prepared with this one-pager. Some people call it a teaser, which is a succinct description of what's my product, what's the opportunity, the size, and the logical flow. And then in addition, the early thing you should have is about a 6 or 7 slide pitch deck. And it's a logic flow. I can help you with that if you need that, but it's a logic flow of what's the product, what's the opportunity, why is it a good product. In terms of a business plan, there should be at least a minimal pro forma financial projection, and there should be how am I going to sell the product, and there should be how much money do I need and what do I need it for. You can put that in 7 slides very easily. So my answer to the question would be a 1-page teaser, which is prose, and a 6 or 7 slide presentation that's net and very high level.
I want to go back to what you said about understanding what investor you're approaching, okay? And I can tell you from our standpoint, being sort of a large angel group bordering on venture capital, a 1-pager is not relevant to us. I mean, granted, you have to apply, you need to have those factors, but when we're going to put up money, and we, somewhere between $250 and $2 million, we're not going to be happy with just somebody coming in to chat, all right? We really want to know exactly where you're going and what you're doing. If you want that type of initial investment, which I think is actually important, because you're not going to be able to come to a large angel group or venture capital group with an idea, with something that's just starting out. But you do need money periodically, right? I'm with you. I don't know anybody who, no companies that we see.
We gotta hang around.
Yeah, we do. I need to know your companies, that's right. But that's where the friends and family come in. The friends and family, your first rounds, is what you were talking about. People who know you, your friends, your relatives, who they know, come in and basically fund initially and give you that boost. So then you have something that you've proven out and can create something that is a more substantial presentation, whatever that may be, to go to the professional investors. And That's
What do you need as a professional investor?
well, somebody who is thinking about not only the 250 to whatever $2 million investment, but then following the company for the next round and the next round to be there for exit. And I mean, everybody who's investing wants to be there for exit, but wanting to be sure that there is a good visible path to exit and where you can bring the money to bear so that you can do it. I think at Golden Seeds, what we learned is that our biggest problem when we started out was we couldn't bring enough money to the table to really help the companies once they got our initial investment. And then they needed another big round for growth capital. Yes, we tried, we would go out and syndicate, but it would have been so much easier if we were able to bring the bigger money to help drive those companies sort of over that hump and get them into the growth stage.
But so to explore a little bit about what you said, so I probably make 3 introductions a week. So let's say 150 times a year. I'm taking a new small early stage company and sending a note to a VC seed stage or angel person who I know and asking them, are you interested in this? There's no way that I can do that with a business plan, a 7-page deck, even though those things are important to have, because no one will open my emails. Right, I've got to have something that's above the fold. So if the question is, what's the first thing you need? For me, if you want to get into and be part of that network to make that introduction, I need a ghost-written little paragraph that says in 2 sentences what you do. And by the way, if you can't say in 2 sentences what you do, go back into the room until you can do it, because you're not going to get anywhere until you can do it. And then I need that 1 page that I can send to you and say, would you like to learn more? And then you'll dig into your process.
Right. Yeah. But then my response to you will be, yeah, this fits our criteria. This looks good. Now have the people apply, and here's what we need to know for you to move forward with the application.
Now you're also a little odd in that respect because you have an application process.
Well,
we have an application too. Yeah, a lot of early stage groups do. Sorry.
The other thing I'm interested in what you said, which I think at the margin I disagree with, is I think I'd guess the 85th percentile of angel or seed stage investors don't have enough money to do future rounds. No, there's virtually no seed stage fund that I can think of. True seed stage, where they're investing pre-revenue at less than $1 million a round, has enough cash to take that company all the way through to the end. They all need that second stage, right? I mean, Bowery needs Insight and Wellington and Sapphire to follow on. There's none of them will have enough money to get all the way through $20 or $30 million worth of investment.
True, but if you can, I mean, we were able to raise a $26 million fund, and along with our 300 angels, we can do now a more substantial follow-on round. But you're right. I mean, no matter what, we're not going to end up being able to fund, $30 million. But I think to get those other companies involved, it helps when your lead investor is able to put up the additional amount of money, which is also an important thing to talk about eventually as to who you want to be your lead investor.
And to tag on to that, it always takes more money than you guys anticipate. I can't think of one company that we've invested in that hasn't come around for the seed extension round or the bridge or the post-seed or the pre-A or whatever they're calling it, but they're always coming back to the previous investors to cover that an additional 6 to 12 month gap before the Series A investors come in, or Series B, whatever it is. So, some of the seed funds do have for that purpose, but they definitely don't have enough for those $20 million rounds or $30 million rounds.
Well, let's talk about how should I decide? How should I decide who I should go to? What criteria should I use to select an investor if I have the luxury of doing that.
You have to get in front of a lot of people before you want it to raise money. You have to be out in the ecosystem, shake a lot of hands, get a lot of advice for a number of reasons. One, you'll learn what the appetite of all the different investors are, how active each investor is, because some people like to say they're active, but they may only do one deal a year. And then you'll also meet folks that will become indirect advisors or mentors, and they could be investors themselves or warmly introduce you to their colleagues. There's one company that we're in deep due diligence on right now. I met the entrepreneur 2.5 years ago. You know, he wasn't ready, and we just didn't have enough traction or enough validation from even the product, let alone the market, back then when we first met him. But he kept coming back to me, you know, once, twice a year. Here's an update, can I pick your brain? And then when it was right, we put him into our pipeline. So it's a long process.
So in my experience, I've noticed two types of investors. One's either a former financier or somebody who's built a business and been a former executive operator, if you will. If you understand the difference between those two, you can talk to certain interests. Some people are more product focused versus some people who are more return focused, right? So if you understand if somebody was a former banker and looks at businesses a certain way, you can talk to that in your conversations so as not to waste your time or their time, right? If he was a former executive operator and understands what drives business, talk to those KPIs, and it's a different sort of conversation that you'd be having over time. That's really where.
Yeah, from the perspective of an incubator company, let's say a very small, you've got an idea, you're working in a lab, and you're at total zero, maybe even pre-revenue. I think Ray, or one of the gentlemen, said here that the networking is the key. There's no magic. You have to spread your information around, and if you're an incubator company right now, you have to look to your executive in residence advisor, one of the people on this panel, and begin your networking that way. It's very hard to go online and just start finding opportunities of money. It's going to be tough to do. Whereas you can shortcut the circuit a lot by personal contact and having an expanding network. So, I mean, you're in an incubator now and you've got some advisors and sponsors and so forth. That will be the place I would start and go from there.
Well, the one thing I would say is that if you're raising money and you are thinking about who you're going to be dealing with, you should be doing due diligence on your investor as much as they are doing due diligence on you. You should be able to check to see if they deal with all the parties fairly, because you will find that not every investor is the kind that you will want to have on your side of the table, let's say that, or on the opposite side of the table. And then the other thing I would say is, besides doing the due diligence to make sure that they match your views, you should also be looking for an investor that brings something other than money. I mean, I know it's hard to get money, I understand that, but what is even more valuable than money is the Rolodex, the contacts, the introductions that your investors are going to be able to make to you. So those are also things that you should be thinking about when you're thinking of who is going to be your investor.
I'll repeat again and then give some specific examples, but it's utterly behavioral. It's absolutely about networking. If you are not plugged into the entrepreneurial community, get plugged in. It's not that hard. Go to venturecrush.com, which is the website that Lowenstein runs. There is at least one event a month that we run. We're a machine for networking.
I get
Yeah,
emails.
Good. You don't come though. No. You gotta show up. In fact, we'll stop sending you emails if you show up. That's so how do I network? Well, first thing, one of the first things you used to think about is who's going to vouch for you, because most people who are active in this space will only work with and interact with people who come recommended to them. The volume of humanity in this space is so large, right? At some level, everybody's an entrepreneur. And you should absolutely not spray and pray. It is disqualifying. If I get an unsolicited email from an entrepreneur, I don't want to work with them and won't. And the reason I won't, neither as an investor nor as a lawyer, is because he or she's demonstrated to me that he's stupid. Just hasn't thought through what they're doing. So don't spray and pray, particularly at early stage. You can get away with it a little more in the later rounds of funding, but you can't get away with it early. So sit down and think about, what are your resources? Who are the people who know you, who are in the space, who will say nice things about you? And they may not even know your business, but they'll say you're honest, upstanding person, high integrity, hardworking. All of those things matter. And who can make introductions for you in that respect? The other thing to think about is you probably have more network than you realize, right? Somebody, for example, if let's take a typical software, early stage software startup, somebody is helping you write that code, right? Usually an outsider, maybe a development shop. Who do they know, right? What have they seen in that space? If you may have a beta customer, or at least somebody who, if they're not a beta customer yet, if you're still at the alpha or proof of concept stage, somebody who you've talked to in the user community for your end product, who's enthusiastic about the product. They are a potential investor, first of all, because they already understand the nature of the value that you are attempting to bring, but they're definitely a source of network opportunities, because you can say to them, hey, if I built this, who do you know who would be interested in it? Right? So start to mine your own universe, your own network of possibilities. It's already from the beginning deeper than you think. And for your very early stage money, think about the concept of close network versus loose network. It's very unusual for people raising their first $250,000, let's say, who are first-time entrepreneurs. Very different experience for a second-time entrepreneur who has raised money before. Very different experience for a entrepreneur who has exited before, even if the exit was shitty. Shitty exits still count. They're better than zero. They're not tax events. So close network are people who know you well, who are likely to write a check just because they think highly of you, even if they don't really understand your idea. That's the group of people who you're most likely, 85, 90% of the time, going to raise your first couple $100,000 from. One of those people may be you. It may be your own pocket. Right? Yeah, go ahead.
Are you more impressed with people who can do the friends and family networking and raising money versus somebody who has a good product? Do you ever see that kind of balance where you have somebody who has a mediocre product or a mediocre strategy, but they were able to raise a lot of money?
I see a lot. Tons of people who have mediocre strategies to raise huge, giant piles of money. They are responsible for lots of tax losses.
You know, there's another theme that you may or may not be picking up here, and that was mentioned. And there are more or less oversimplified two general categories of investors. Financial investors that want to put money in and make money, and that's their primary interest. And a term you'll hear, strategic investors, which is referred to that people that will also be able to help you in your business. In other words, you may have a product that's an adjunct to a product that they have that enhances their offer, or as investors in you, they, as somebody mentioned, have a Rolodex that can help you. So generally speaking, it's oversimplified, but keep in the back of your mind that there are two kinds of investors, the financial only and the strategic. And there's gradients in there, but that's an important thing for you to realize as you're talking to potential investors. Usually you're better off if you can have a strategic investor / partner, far better off than a pure person that's interested in making some money from you.
To attack your question a little bit, I think that when you get to the point that you're ready to access loose network, people who will invest more for financial reasons, as Dick says, less for reasons that are connected to their view of you, I don't think they care how you got there, right? Whether you raise money from friends and family or bootstrapped and ate ramen noodles for 7 months, you got there. You got through the concept stage, through the alpha stage, you're at a beta stage, you have a potential beta customer at least, and you're out there in a position where you can talk to people about writing $500,000 checks who are in institutional or quasi-institutional environments. They don't care how you made it from that point. It doesn't make any difference if you got there, created a great product, and just did it all yourself, or got a couple $100,000. It does speak a little bit to your resourcefulness, though.
And that's what I wanted to get to. The important thing about bringing friends and family money and your own is dedication and is belief. And if they don't invest in you, if your friends and family have turned you down, why the hell should I? If you can't convince the people that love you the most to put in $10,000, $50,000, why should I trust that you're who you say you are? So when we look at a company, and Ray's absolutely right, if you bootstrapped and got there without any outside capital, that's fine. And you got to make that part of the story. But we look at, well, who has this person been able to bring on board? It's friends and family, it's co-founders, it's employees. Employees are working for less salary at your startup than they would be if they were out in the market. So how good of a salesperson are you? And how good are you at explaining your vision and bringing people on board to believe in what you are? If you can't make those constituents, then how are you going to get customers? How are you going to get us? Sorry, I jumped in there.
No, but it's an interesting point. But I just want to add one point to this, and that is, I actually do think it's important how you raise that money in the sense of structure. All right. So if you're raising it because you're giving your friends and family a senior note, right? Then you're expecting people to come in and provide you with equity so you can pay off the earlier investors. People are not going to be happy. If you're crowdsourcing and adding a huge amount of individual people on your cap table, where there's a real question of are they accredited investors or not, I think that becomes a problem. So I agree with everything everybody said here, with this one little caveat that you have to be very careful with the structure of that money that comes in, so you don't jeopardize your ability to get that next round.
Right. Talk to somebody who's done it before. It doesn't have to be a lawyer, although sometimes it's good to talk to lawyers. Not usually, though.
I mean, we've seen companies with
but talk to
right?
somebody who's done it before.
Haven't you seen companies where the balance sheet is just frightening?
I've turned down clients,
right?
Because you can't help them. A rule of thumb that you should keep in mind as you go through this is, as a general rule, new money does not respect old money. You do not raise new money in order to provide return or liquidity to old money. You will never be able to raise money for that, and your existing investors, whether they be friends and family or professionals, damn well better understand that. And there are actually a lot of institutional fund investors who don't understand it very well, and I get the privilege of explaining it to them.
And when you're setting things up, especially the first round of documents, go see Ray, go see somebody who's done this before. While your attorneys who are friends of yours, or they may be able to do it for cheaper, or may say, like, I'll just do it for you for free, they're going to muck it up. Go see somebody who knows how venture capital works, how angel investing works. It will save you a lot of time and frustration and money at the next round.
And even if it's not a lawyer, talk to somebody. There are plenty of people out there who have done this 2 or 3 times. There are entrepreneurs who have done it. There are investors who have done it. At minimum, just talk to somebody who's been through it before, because you're so completely right. You can actually destroy your and probably the best piece of advice we can ever give you: do not go on Shark Tank. They are criminals. The things that you will sign will wreck your company forever. If you do. All of those types, I single them out because they deserve it, but all of those types of operations are absolutely horrible, and I can run you a list of 24 great entrepreneurs who were wrecked by participating in those operations and literally signing away all of their future rights. So don't do that.
Yeah, I would add to that, or say the same thing, in effect, that it's very important that once you get the enthusiasm in your mind, you've got some money, you're raised, you're ready to go, you really then have to pay attention to the terms that you're signing up for. And there's a term, shark, which is there for a reason. There are people that will totally pick your pocket. They will put covenants and terms and conditions into the financing that will come back and bite you if you're not very careful. So I think, as Ray mentioned, you have to get alongside and be counseled by somebody whom you trust and has done it many times before and knows the loopholes and the traps. You just cannot go in on your own.
There's also a website, the NVCA website has forms. I mean, they're boilerplate, but at least it could be a place to start so that you can understand what type of terms and conditions are normal, right? And then you will be able to see what gets added by the thing.
Let's talk about that a little bit more.
National Venture Capital.
Oh, I'm sorry.
Association.
Thank you.
I'm sorry. Let's talk about that a little bit more. What are some of the terms and covenants that young entrepreneurs should be cautious of?
One is an easy trap is if you lay out a pro forma business plan and talk about quarterly revenue coming up in certain amounts, some investors will say, okay, you're going to meet those goals. But if you miss that goal, the following consequence happens. You have to be very careful of that. You could miss a quarter, 2 or 3 quarters out, and pow, they up their equity stake in your business as a result or whatever. So one thing to watch out for is the commitments that you make financially quarter by quarter, and be careful that they're not tied too directly to adverse consequences.
I would say more broadly, complexity as a entrepreneur, particularly an early stage entrepreneur, is your enemy. The venture space is built to minimize friction because it can't afford friction because cash is such a sorely needed resource, much more valuable than it is in later stage and growth stage companies in many respects. So it's a very small universe. It doesn't suffer, to your point before, John, it doesn't suffer bad actors. Well, it gets rid of them, spits them out because the community is small and it knows them. So complexity is your enemy. Don't create unique, customized, negotiated rules for yourself that will be incredibly difficult to paper, expensive to paper, time-consuming to negotiate. Right? There is a format for doing this. The format, it's like DNA, right? The DNA of a daffodil is 98% the same as a human being. Right? DNA for all living things. There's a set of existing market terms, and they flow back and forth. Sometimes the discount is this, sometimes the discount is that, but the discount is always there, and it's a relatively narrow range. Standard deviation is very low in this environment. You don't need to reinvent the wheel, and there's a reason for that. The industry has organized itself at early stage as a low complexity, low friction industry for a very important reason. So go out and find people who have been in it, all of the folks here, because they'll know what the market terms are. They'll know there are 5 or 6 basic terms for a convertible note. There are 5 or 6 basic terms for a light preferred stock, and they're pretty much always the same. And if you've got an investor coming to you that's got sort of a fancy way of doing it, and I'm going to put in $100,000, but I'm going to give it to you $25,000 at a time over 3 months, tell them to go away, because you actually can't afford that level of complexity. It will eventually strangle your business.
The only thing I would add, though, and I absolutely agree, and that's why the boilerplate documents are really the best place to start. But I will say that you shouldn't be afraid of terms and conditions that add governance. I think the pushback that we get most often is, why do I have to have a board? Or why do I have to have 5 people on the board? Why do I have to provide you with information rights? These are all issues about governance, and they're there to actually help you, the entrepreneur. The more people, the reason to have a board, is that it brings more people around when you have to raise money or something goes wrong. All of a sudden, you don't want to be by yourself. You've got people around you. The idea of information rights, it doesn't have to be extensive and it doesn't have to be tied to investment. It's just information rights. Helps you have the discipline to make sure you know exactly what's happening to your money on a timely basis. And so that's the only thing I would say. The terms and conditions of whether it's the drag-along rights or the ratchets or the whatever it is, are all in the documents, and it's there's nobody who's going to disagree with it. But I would just say, don't be afraid when your investor wants to be sure that there is these governance items in there.
I'll add 3 points. The first is know your documents, know what they say. And I recently went through this exercise with an entrepreneur. She was representing her documents incorrectly and thought that they said one thing, that certain things were going to trigger a conversion. And when I read it, I said, there's absolutely nothing in there that says, this is going to happen or that it's going to trigger. And she's like, what do you mean? We went back and forth for a month just on this one term. The investment didn't happen, but just that fact that she didn't know what her document said was a big issue for us, because if you don't know what you're representing out in the world, like that's a problem. The other is
so she didn't read the document. Is that basically it?
I have no idea if she read it or not,
No,
but I
okay.
know she didn't understand what it said, and it was a safe note actually, and you can hear the groans. We can discuss convertible notes and safes and equity.
Coming out of California.
So know your documents. The second is valuation is extremely important, even if it's a cap. If you come out and you tell me that you think the cap is 50 million and you're going to stick to that because there's a 20% discount, I don't care, because you're still overvaluing your company. My base assumption as an early stage investor is your cap is the floor price of the next round. That's been an argument between us and companies throughout, and I'm sure you will be able to comment. We do, however, add contingencies to some of our investments. They're usually, one of two things. If we're committing early in the round, we want to know that at least 50% is going to be there. So we don't want to be, the first $100,000 in, and then find out a month later we're the only money in and you've spent it all and now you're flat broke. So this is not anything we put in the documents. This is not, nothing really legal. It's just like, hey, you have our commitment. Our money's in our bank. We will wire it to you as soon as you give us the assurance that you've got, 500 of the million committed.
We actually put that in the documents.
You do?
Don't you?
Okay.
Don't you put that in the documents?
I don't.
Minimum close.
Yeah.
We put a minimum close in for exactly that reason. That's a good point.
The other is at times when there's big milestones happening, we'll say we're going to give you 50,000 today, and when those happen, we'll give you another 50,000 because now you've de-risked it even more. So we do split up our tranches, but we always make sure that there's something up front so the company knows how serious we are.
When you invest in early stage companies, regardless of their whether really early or in the middle or whatever round they're in, is there an expectation that you have that there's a high likelihood somebody might make it to exit, or that they have a better chance than others? How do you view your pipeline?
They better all have a strong chance for exit, otherwise why are we investing?
I totally agree. Right?
Yeah.
That still means that 9 of 10 of them are not going to get there.
Yeah.
But nobody ever writes a check and says, well, I know this sucks. Right? Or, look, if you know people like that, I'd like to meet them.
Yeah.
Because I have a lot of ideas that suck.
Let's talk a little bit about what the difference is between angel investment, venture, and private capital, so that everybody gets that baseline understanding.
These three terms state where you are in your business. Typically, angels will come in with little to no revenues after the FFF round. Private equity is very structured, and they look for consistent cash flows to cover a lot of the investment that they have. The businesses that they invest in are typically more mature and have sufficient cash flow to cover some of the investment dollars that they are willing to invest in that particular business. Venture is in between. So it's, I like to think it's like when you're expanding very, very rapidly, a venture fund will like to see some revenues, but also sees the upside in infusing not only cash, but also certain expertise levels to help you execute more efficiently at scale. So it's like you going from here to here, which is where venture wants to take you. Angel is just fairly early, just trying to get your footing, and private equity is when you're on cruise control and can cash flow and pay people back and return that investment that they've invested in you.
That's well said. I wouldn't add anything to that.
Okay.
The thing I would link that to, though, a very excellent description, is to something that you said about researching your potential investors. Right. So I have a great relationship with Insight Venture Partners, one of the largest venture funds in the world, and Insight thinks that they do early stage deals. That's what they say. Their definition of an early stage deal is totally different than any normal human being's definition of an early stage deal. But you can find that out because you can go look at their portfolio companies, look at the investments that they've done. If you can't find them on their own website, you can do one of the services like Crunchbase or CB Insights, which are all great. So there are lots of folks out there, and you said venture sort of, leaks to both ends. A lot of venture funds will describe themselves as doing early stage stuff, and you have to see what their definition of early stage is to see whether it fits you guys. Edison in New Jersey for a long time would say they did early stage stuff. They don't do early stage stuff, not by any rational definition of early stage. But if all you did was look at the site, we do early stage investments there, you'll send a business plan and you've wasted your time. So doing background research, the same way you do background research on your product and on your marketing and on everything else, do background research on the investors, because the stage definitions are incredibly fluid, and that vocabulary is very inconsistent inside of the industry itself. And so understanding exactly what that fund or that angel group is interested in and does is going to be to your benefit.
That's a good point. I mean, the definition is so loose on that. I mean, you could say family, angel, venture, private equity, but that's
the only one you can really define is private equity, because private equity is usually heavily revenue driven, heavily
Service Capital bought Chrysler
and controlled
like
transactions.
That's not
we
really
wish someday that all of you will
you
need
should
private
be there.
equity.
How about if we throw crowdfunding into the mix? Because very often young entrepreneurs say that's going to be a great place to get their first influx of capital.
Anybody here who doesn't think it's a race to the bottom?
Well, it depends. Is it the crowd donation platforms like Kickstarter, which you're not giving away equity, and that's a great way to validate your customer base and get some initial marketing interest. But if it's crowd investing,
Yeah, I mean, basically that kind of stuff is if you have a project, you want to produce a Broadway play, or you want to do a record, or create some form of art. So I think that's probably not going to be stuff that's interesting to this group. Is that a fair statement? Would you agree with that?
Well, but pre-sales, I mean, you have a good point. Pre-sale is a very good use of AngelList, Kickstarter, that kind of stuff. Pre-sale of product, and that's not really fundraising, as you say. Yeah. The only people I've ever seen be truly successful in the crowdfunding universe are people who use it on a curated basis. So they in effect use an AngelList platform or a Kickstarter platform as a networking tool. And they're really not fundraising on the platform as much as they're getting active leads and then curating those leads through their own knowledge network. It's a terrible idea. Just a terrible idea.
There are regulations that are so non-understandable that can actually put you at risk of not being able to raise another round if you cross a line somewhere. And I'm the last one who's going to be able to tell you what that regulation says, but I can tell you there is regulation out there that makes it a very slippery slope if you're going to raise equity through that.
It's especially for the unaccredited investors.
Well, exactly. Right. It's because of the unaccredited investors.
If you want to DQ yourself from a venture fund, tell them that you've raised money on Kickstarter. Because
Not
it's
Kickstarter,
or AngelList,
Yeah.
or any of
Any of
them.
those.
Because it's a race to the bottom. Their theory will be, if you could have raised money any other way, you would have, and so all the shit flows down to the effluent pipe.
We have seen some of our portfolio companies raise accredited investor capital on certain platforms, but it's only to fill out a round. It was another $100,000 to $200,000 after the angels and micro VCs came in, and they only took money from accredited investors. So that's a very specific distinction. This is not the average everyday person. These are still accredited angel investors or firms that can. This is just giving them a different access point in. And and it was through Seed Invest, which is the main one in our region.
But you know, the problem with that is if to get that 100,000, you end up with an extra 200 people on your cap table. When you go to the next round or go to exit, when there is this enormous amount of names on the cap table, it puts you at a disadvantage.
If you have a strong angel in your group and you're filling out, you would never let somebody that you were investing in do that. You would.
No, you're right, because that's right.
And the companies that we've seen had 4 people come in from the accredited, from the
okay.
platform,
But-
not 200. I would never,
right,
oh
but-
my God, no.
I'm saying
That
but
would be
that's
totally-
well, but that's the risk.
That is the
in
risk.
using
So crowd is a bad
those
word.
sort of sources.
Yeah, don't bring
Crowd's
the crowd.
fluid like stage.
Yeah. I think we're in agreement. Kickstarter is a good way to test your product or raise money for projects or art. Be wary of using the angel list or crowd investing platforms.
Keep that divorced from buying a piece of your company, right?
Yeah.
You want to do a project with somebody, but not an equity investor or whatever.
And the equity investment platforms, they're pretty expensive. They're not cheap. They have tens of thousands of dollars of upfront cost plus a success fee. Several points on what they raise for you. So be wary of that.
So, as the closing question, what's the number one piece of advice you would give a startup company in the early stage as they're beginning to look for funding?
I would go back to having a one-page description of your company and 7 slides to describe the various things, the product, the opportunity, and so forth. But the point there is to create those slides with some depth behind them. You have to have thought through what your product is, who your customer is, what your pro forma is, what your marketing strategy is, what you're going to use the funds for. So it's pretty simple. I can help any of you that like with what you want to do, but just you have to get that logic flow set in your mind. Each one of those items is critical. The product, the proof, the finances, and so forth. So, and I think as Ray also said, don't try and overcomplicate it, especially at the early stage. You just want to get your mind around the logic flow of what you have and what you're offering and what you want to raise with.
I think it's important to take action and keep moving because, you can finish your business plan, your pitch deck, and your one-page executive, but then what? You have to go and start asking people, are these hypotheses correct? And if you can disprove them, you'll save yourself a lot of time and energy down the road because you found out that your customer either wants to buy it or doesn't want to buy it, and then you can adapt going forward. So just keep moving and keep trying and hypothesizing. That's what I would say.
That was going to be mine. I mean, because just doing it means so much to the investor community. So I'll just add that it's important to listen to all the feedback that's coming at you. You're going to get a ton of feedback from everybody because everybody's going to have an opinion on how you should build your company. But hear people out, especially the investors and other entrepreneurs that you talk to. Doesn't mean you have to take their advice or follow whatever they say, but internalize it because everybody here on the panel speaks from a perspective of experience and wanting to help. So just internalize the feedback and use it however you wish.
And so I'll say again something I said a couple of times during the course of this. Network is the key. Relationships are the key. You cannot be a successful entrepreneur if you're going to live inside your own head. You have got to continually add people to your network, people who think highly of you, people who trust you, even if you're unsuccessful, even if they don't invest, even if they won't partner with you. You have to continually add people. If you're not adding 2 or 3 folks a week that you're meeting to your network around the space that you want to be in, you're just doing it wrong. Relationships will make you successful.
All right, so I have just 2 thoughts. All right, the first is that when you present the milestones that you're going to achieve over whatever it is, the course of 1 year, 2 year, 3 years, when you're going out to ask people for money. I think it is really important to set those milestones realistically. I know that there is a debate as to whether I have to have the hockey stick show some extraordinary growth in order to attract the money. But the problem is, if you miss those milestones, then you spend the next time that you're in front of investors, instead of talking about the business and where you're going, you spend the next meeting explaining why you failed. Why was it bad? Why was it bad? And I always find it fascinating that in the startup world, there's this tendency to overpromise and underdeliver. I spent my career on Wall Street, and the one thing public companies do is set very low bars, exceed that, and what happens? The stock price soars, right? But for some reason in the startup world, there isn't this understanding that you must meet your milestones. So that's the first advice I would give you. The second thing is to be sensitive to valuation. And we talked about that before, but you have to understand how investors, at least angel investors, think about valuation, and they think about it sort of working backwards. Okay, so I mean, you might say, well, I think I'm worth 3 million. I think I'm worth 5 million. I think I'm worth 10 million. But in reality, what the investor is going to do is say, all right, here's the price for this percentage of your company, right? Then, over the next few years, you're going to raise that additional $10 million, and my percentage ownership is diluted, right? And then hopefully you'll get to a point where your revenues reach X, you get sold at 3 times revenues, and working back, given the dilution of that initial investment, what is my return? Did I get 10 times my money? Did I get 2 times my money? So it's not that investors are just being difficult. There really is some rationale between how they think about the valuation and how you think about the valuation. So that would be just my 2 points.
Great. Thank you so much. Wasn't that like a really valuable session today? Let's all give them a round of applause. Does anyone have any questions you'd like to ask?
Directed to all of you, what is, outside of the product itself, what's the most impressive thing that you've seen, tangible or intangible, from somebody pitching to you, or that you've helped pitch or helped present to investors? What's the most impressive thing that you've seen?
Well, I'll start. I think the most impressive thing, because I think it's actually difficult, is the ability of a startup to attract talent into the organization. And so when you have a startup that can attract talent, and it may not be employment, it may just be an advisory committee, but when you see those startups that have the talent around them, I would say that's pretty impressive.
I spent a lot of my time, probably a good 70% of it, in pre-revenue companies. So the thing that I always find impressive is a consistent ability to convert beta customers into money. There are plenty of people who can get folks to test out their idea. Far fewer of them continue to use that idea when they have to pay for it. So converting beta into money is a big friggin' deal for me.
It's the people. Like they said, it's the leadership and the salesmanship of the entrepreneur.
For me, it's just the resilience or adaptability of the group of founders. When the market shifts on you, what are you prepared to do and deal with? That's really important. Do you know the risk, and how are you going to go about addressing and maneuvering through them?
I would say it's thoroughness and depth. In other words, when you're talking to somebody about their company, you want to understand that they thoroughly understand each of the elements of their business and that they can go down a couple of levels in terms of depth and backing it up and proving it. So I would say thoroughness and depth and understanding of the business that you have. Obviously, people, as everybody's mentioned, is critical leadership, but you can't just take one piece. I've got this great product, and by the way, I might sell this much and I might market it this way. It's got to be deep on all aspects of your business.
That's actually a really important point, because if you have a phone call with an investor and you're just on the call and you're talking to him or her, know that they're Googling everything you say. So if they're learning more by Googling than you can explain to them, you're in trouble. And this has happened, like I've been on phone calls where they've told me that they have no competitors, and I'm like, well, I just searched and I found like 20, so.
But I also want to add a comment about moving along and understanding that. I would also say that it's really impressive when you see a company able to pivot when they have to pivot, as opposed to refusing to acknowledge that their plan wasn't going to work. Either wasn't going to work in the sense of scalability, or wasn't going to work in the sense of, as you say, converting to beta, and things like that. So if you can actually find a management team that sees value in their product, but maybe not necessarily the initial way, but then can pivot and continue to move forward, I think that's impressive too.
How do we value our company through revenue?
You make it up. You make it up. There's no. It was explained to you here. You value it backwards, right? The investor has a certain amount of money they've decided they want to put to work in your company, and they want to own a percentage of the company for that amount of money. So, by the way, that's the math evaluation. That's going to get them, after the anticipated additional raises, to a percentage ownership and an exit multiple. By the way, there's don't be a pig is a good rule here. We'll do some quick math, right? Let's suppose you're raising $1 million. You have an opportunity to raise at $4 million, but your investor wants to invest at $3 million pre, right? Oh my God, a 25% reduction in valuation. You know how much that costs you in ownership of the company? 5%. Don't be stupid. Take the money. Right? Take the money. Don't get so bound up in the edge of valuation at early stage. If you're talking about a $10 million raise in a growth stage company, we can have a different type of conversation. But if you're in an early stage company, understand the math at the edge is not particularly important for you as an entrepreneur.
Talk to people. Go to other investors, talk to other entrepreneurs, and just ask.
How much do you care about those entrepreneurs being able to spit out a reasonable DCF in a pre-revenue company? Are you even looking at that, or no?
That valuation, the approach doesn't apply to a pre-revenue company. So it's like, like you said, just make a number up that's believable. I mean, it's all
Say
based.
it to a bunch of people, and the number that they don't laugh at, that's the number that you.
It's a supply and demand game, essentially.
Well, but call investors that aren't investing and be like, look, this is where I'm at. You know, what should I be looking for?
Yeah. It's actually, again, it's a networking point, but the analysts that work at venture funds are rough contemporaries of most of the folks in this audience, right? My son is one of them. He's 25 years old, right? Unlike the senior folks in the venture funds, the partners or even the VPs, the analysts are looking for network. And those are great people to call. Not investing in the company, maybe not even appropriate, but to give them a call and say, hey, here's the way I'm thinking about this. If I said this to you, would you think I was an idiot, right? Have that conversation 5 times with people, who are, again, your own age, rough contemporaries of you who are doing that job, and you'll get an idea of what makes sense.
I wouldn't totally give up on the idea of a net present value analysis, because you have to come up with something. So if you have an idea for a product, you have to guess how much you're going to sell and what your profit would be and so forth, and then work that back to a net present value. So I wouldn't discount that, and you have to have something to hang your hat on. So I wouldn't. I would think that could be valuable as one of the elements of your evaluation.
Dick, how much emphasis do you put on the financial statements in the early stage?
It's not too much, but you need something. You know, if you don't put it on the financial, you have to say, here's the product, it's going to go to the market, and it's going to produce this much revenue and that much profit. That's the only reason you're in business. So you have to have some concept of what it's going to do.
But to that point, the assumptions of that model have to be believable, right?
Absolutely.
They have to be able to talk to each assumption that they've made.
Absolutely.
And it has to be believable. So you can do the DCF, but the assumptions have to be believable. Or you can just throw something up that's believable and it might work.
I'm over the former school. I'd like to start with something.
And the D is the D is less important, right? Cash flow analysis is actually pretty important, particularly on the expense side, right? I want to know how much you're going to spend and what you're going to do with it. And by the way, bring in your development project on budget and on time. You'll be a popular person with the investment community as a whole. Most people can't do it. Most first-time entrepreneurs, most second-time entrepreneurs can't do it. But I think that investors are going to pay a lot of attention to the expense side in the true early-stage pre-revenue company because they want to know, you're going to write this piece of software. Can you really get it done for that amount of money? Prove it to me. Show me the contract. Let me talk to the people in the Ukraine who are going to write your code for you. Or Brazil.
I don't want to speak for everybody here, but when we look at it, it's more to make sure that the entrepreneur knows how to run a business and knows what the expenses are going to be and can properly budget and make the right assumptions. It's not the hockey stick because, as was mentioned before, everybody has a hockey stick and nobody's going to hit it.
How much would a minimum amount of money be that would justify you looking for venture capitalist investments or angel investors? How much would be a minimum amount of money?
It's a very hard question to answer. There are funds out there that'll write $250,000 checks, $500,000 checks. Depends on the nature of your business stage of development. I don't think you can attack. Let me say it this way. If what you need is $50K to get your startup done and to write a little bit of code, that's not a VC investment. That's got to be close network, probably friends and family. Once you get into six digits, they're now called micro funds. They used to just be called venture funds when I was a young man. Funds of $10, $15, $20 million that will write $200,000 checks. So you really need to, again, as everyone has said before, talk to folks who have been through it before to understand your specific circumstance and are you right for that particular type of, there's one right in Newark Venture Partners that does $250K deals all the time.
But I don't know if they do it alone. They usually syndicate.
Sometimes.
It's usually a larger round.
Sometimes, but not always. We've done a couple of deals for them where they were the first, right. and then they brought a later sub round in, and wrote the check. So you just need to do that background research. You need to understand who you are inside of the industry and who you can connect with.
I think your question is good, though. Is there some point in which you're not going to be talking to venture capitalists? But you want to talk to friends and family and angel investors, right? And that, I don't know what the mark is, maybe it's $100,000 or more that may be qualified, but if you're in the $75,000, $50,000, $25,000 range, your friends and family, your angel investors, that kind of thing, I think that's what you're after as well, right?
Okay, well, thank you so very much, panelists. It was an excellent session, and I'm sure that you guys learned a lot, right? Okay, so final round of applause.